Hey everyone, in this video I want to talk about why you should be investing in the stock market and why you should start doing it right now or at an early age. A lot of people find the stock market very scary. There's the potential to lose money. Some people think maybe I can do this later in life when I have more money. Using the stock market, we can reach our goals of retiring early, financial freedom, and just having a large sum of cash if that's what you want a lot sooner than if you just work your day-to-day job and only use that money and only save that money. So in this video, I really want to go over and stress how important it is to get into the stock market, why it's so important, inspire you hopefully to jump into investing in the stock market, being safe, and retiring early and hitting all your financial goals. When thinking of retiring, the main thing we think about is how much money do I need to retire to cover myself for all the years I have left, not knowing how many years that might be. A famous rule that people have been using for years is the 4% rule. This rule states that if you have a large sum of money in the stock market or in your investments, it doesn't have to be the stock market, you should safely be able to take out around 4% a year and live off that 4% each year. And it's a small enough chunk that the remaining money will continue to grow and not be affected, meaning you can continually take out 4, and some say now 5% a year and live off that money. Let's go over some examples and numbers here. Say you want $40,000 a year and you can live off that amount of money every year into retirement. What you need to save is up to $1 million, meaning that $1 million you can take 4% of that, which is $40,000, and live off that 4% each year. Say you want $60,000 per year, that means you need $1.5 million saved up. So when you take 4% out, it equals $60,000. Now say you want to live a little larger, maybe go to the fancy golf courses, or you just want more money to keep yourself safe, and you want to have $80,000 a year, which is well above the average American salary. You need $2 million invested to take 4% out every year and still have enough money left over that it'll continually make you money and you'll be safe taking 4% out. Now let's go with the first example, $40,000 a year, because not only is it more realistic, but it looks like a smaller number, only needing $1 million. And I'm still going to show you how crazy and ridiculous that is to get on a regular American salary with the regular rate that Americans save. Now I'm Canadian, but I'm going to use the American rates because it's basically the same. In most of the world, it's somewhat similar, and I'll get more into the differences a little later. $1 million is our goal. How long does it take to make $1 million? Well, the average American salary is $33,000 a year, but let's say in this example, because a lot of people like to think of themselves a little higher or maybe have higher goals for themselves, let's say you make $40,000 a year. Now let's look at the percentage that the average American saves out of their income. Looking on this chart here, it shows that Americans save 7.6% of their income. That means if you follow this chart, your 7.6% savings rate, or the average American one, will take you around 60 years to hit your retirement goals. And usually people are starting their savings a little later in life, or they don't want to work for 60 years straight just to retire when you're past, say, the prime of your life or when you could really go out and do things. With this video, we're going to get into how you can retire earlier in the younger years of your life and basically live for yourself, not working for the man every day. A fun note, this chart is from the Mr. Money Mustache website, a very famous character in the FIRE movement. The FIRE movement is financially independent, retire early. We won't get into that, but that's where this comes from if you want to learn more about it. You can see here they suggest if you have a savings rate of 50% of your income, you can actually retire in around 10 years or 11 years, which is pretty crazy, and obviously most people can't save that much. But we're going to get into these other tools, not just using savings, how we can build our money faster and have a larger amount sooner. Now, if you were just going to save your money in a savings account, we need to talk about one big thing, and that is inflation. The average inflation rate is 2.27% a year. That means your money is worth 2.27% less this year or next year than it was worth this year. So that's going to keep stacking every single year. So if you just have your money in a savings account, and most savings accounts, the average ones have really terrible interest rates, so you're not really making anything with it sitting there, you're actually losing money every year as it's sitting there. Because say in 60 years, that $1 million you had saved earlier will buy you less things because everything on the market goes up in price. A can of Coke used to be $1, now it's $2.75, and it keeps going up from there. That's Canadian dollars, if you're wondering why it's so high. America, it might be different. That means that same amount of cash, if you're holding it from now or in 60 years, will buy you a nicer house now than it would in 60 years because the market is going to go up on everything. Luckily, it's not all negative, and we have a powerful tool known as compound interest to help us get more money faster, and have our money work for us. Now, you don't have to listen to me, I'm just some guy on YouTube, but Albert Einstein, one of the smartest people in history, said compound interest is the eighth wonder of the world. His exact quote was, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." So you don't have to listen to me, Riley, some guy on YouTube talking to you right now about that. Listen to Albert Einstein, the eighth wonder of the world, and a powerful quote from one of the smartest people who ever lived. That's why we're going to use the stock market to access the powerful tool of compound interest, to have our money work for ourselves to make us more money in the long run and retire earlier. If you take the average returns of the stock market, meaning the entire stock market put together, what is the average return or gain they make per year, it averages out to around 10%. There are some years clearly that is a lot lower, some years it is a lot higher. You can look on the charts online during the Depression, during the housing market crash, it literally goes down a lot, but then it goes up over a long period of time. So that over several years, the average goes to around 10%. Now we're actually going to take the number of inflation, which is 2.27%, and we're going to minus that off to 10%, giving us, let's say, a market average return of 7.3%. Now I'm going to show you why compound interest is as crazy as Albert Einstein said it was. I'm going to go into a compound interest calculator and show you what your money will be worth in different scenarios, using the market, not using the market, starting later or starting with more money, how crazy this all is, and this should really inspire you to get into the stock market on its own. For our example here, let's say you have $5,000, and each year from now, you continue to add another $5,000 and you do it over a 40-year period. Over a 40-year period, your money will equal $205,000, which is good, but remember there's also the minus of inflation, and that's just the money sitting there in your savings account, not in a stock market account. Now, using this compound interest calculator, let me show you how crazy compound interest is. Now, using this compound interest calculator, I'm going to use our same numbers. So I start with $5,000, I add $5,000 each year, but now we're going to have an interest rate, or our yearly gains from the stock market, at 7.73%. Over 40 years, instead of having $205,000, we now have $1,304,000. That is a huge difference with the same amount of money. The only difference is, instead of one sitting in a savings account, which you could quickly access, is now sitting in stocks, which you have to ride the wave of them going up and down and averaging out your returns over those 40 years while not taking that money out. I'm sure people who don't know about compound interest or looked into the stock market are pretty blown away with how crazy those numbers are. But I mean, you still have a lot of questions because it can't all be super easy like that, or everyone would be doing it. There obviously has to be some risks. So let's go over some questions some people have, and I'll answer them here. One question I recently got hit with was, what if I waited to enter the stock market later in life when I had more money? Let's go over this with a larger chunk of money, just with later years in the stock market. Say now, instead of $5,000, we started with $50,000. And each year we're adding $10,000 instead of $5,000, so 2 times the amount from before. But instead of going over 40 years, we're only going over 20 years because we entered it later in life. Now remember, our first one, when we started with 40 years and only did $5,000 plus $5,000 each year, was $1.3 million. Now this one, with $50,000, adding $10,000 every year, over 20 years is only $665,000. That is a huge difference, and the only thing that changed there is literally the time, because the second guy had more money to put into the stock market. So as you can see, starting early or starting right now is more important than starting when you have more money, you feel comfortable, or you feel like now's the time to do it. That's you need to start sooner the better, because the first early bit of money you put in could equal out to more money than the larger chunks you put in once you're making more money in your prime. A lot of people say, hey, in my later years, I'm going to be making more money. That's when the majority of my money I'll make for retirement is when I'm older and I'm getting a higher income. But looking at the power of compound interest, even the little bit of money you have now can equal way more than that over a long period of time. Again, that is crazy that a small amount of money will make you more money, and the only difference is time. Not even the hours I'm putting in. It's just time. I've already put those hours in. It's just time it's sitting in itself in the stock market growing. If you still think You should wait to invest when you have more money. Literally replay this part of the video or look up compound interest or play with some numbers in a compound interest calculator. Just Google it. It's nuts, and that should change your mind. If it doesn't, click off the video. Some common questions you might also have are, can't you lose money in the stock market? Yes, of course you can. It goes up and down, and as you can see last year, it went down a lot, and then it bounced back. That is why when you put money in the stock market, it has to be money that you're okay with not having for 20 to 40 years or however long you plan to invest. It isn't money you can just take out because it might be down at the time you need it. We are taking advantage of the average, which the average only happens over a long period of time. So you have to leave it in there for a long period of time to get the average returns. So you're not taking it out at a negative, you're getting the average. So never invest money you might need in the future or you're planning on using in the soon future. Say you have a bunch of money saved up for a down payment on a house. You're like, hey, I'm not gonna get a house for a year or two. That still might be too short a time to put it into the stock market. It's really up to you and your own risk tolerance. But in a scenario like that, I would put it into an online bank account that has a high interest rate. That way, instead of your regular bank account where it has a low interest rate, at least this way, is making you a little bit more money, and it's still liquid cash, which liquid cash means you can instantly grab it. When it's in the stock market, you need to sell it, wait for it to sell, and then you'll have it, but it also might be down at the time, so if you're selling at a negative, it's not good. If it's up, great, boom, you win, but that's the risk and the gamble. I say gamble because it is gambling that you take when you're doing short-term investing. That's why if you want to put money in the stock market, it has to be money you're okay with leaving there for a long period of time to get that average return. The next question might be, how can you safely get the average return of 10% a year from the stock market? Luckily, there's a super easy way to do this, and it is everyone's new favorite way of investing, and they are known as ETFs. An exchange traded fund, ETF for short, is an investment fund that lets you buy a large basket of individual stocks. Normally, to get the average of the market, you would think you need to buy the average market. But of course, there's a commission fee, and if you are Canadian or international and you're buying US stocks, there is a currency exchange fee, which is horrible. You don't want to spend money buying all the stocks, so each of those is a fee. Luckily, ETF, you can buy one stock and it contains or tracks an index, meaning it has multiple stocks within it. Basically making it so you don't have to buy a bunch of stocks, you can just buy the one and it'll track the movement of all the stocks together, getting you the average. Some great examples are VTI, which is the total market index. This fund literally has thousands of stocks. I'll show you some info here. And it tracks all those stocks together, which gives you the average of the market over time. And this is if you want the total market. Another great one is VOO or SPY, SPY. These two just track the top 500 companies in America, known as the S&P 500 index. This is one Warren Buffett, the greatest investor alive, suggests. And this is one I would say as you're getting older, you put more money into, basically as like your safer picks. It tracks the top 500 companies of America, and really the top 500 companies of America swing most of the entire stock market, as crazy as that sounds. So that in itself tracks the stock market with those two. If you're Canadian like me and you don't want to pay for the exchange rate, which is like converting your Canadian dollars to American because they take some money or a percent out of that, you can get VFV, which is an index fund in Canadian dollars that tracks the same as VOO or SPY, with the top 500 companies in the S&P 500. I'm not a financial advisor, so don't take my stuff as advice to go and invest, but these are great options and you should do your own research and look into it yourself. And these are safe options where you're not buying individual stocks, and it's really the way to go for the average person that doesn't want to think about it and just wants to put their money in there and just, you know, out of sight, out of mind, come back in a few years and you made some money. Here's a little plug, sorry if it's annoying, but if you are Canadian and you want to start investing, or this video inspires you to start investing, there'll be a link down in the description where you can sign up for Questrade, which is one of the larger investing brokers in Canada. And the link just helps me out because as soon as you put money in, I get a little commission. If you want to help me out, that's cool. If not, you can literally use anything else. I still use Bank of Montreal and Questrade. I like both of them. They have sign-up bonuses. Questrade, I think you need $1,000 in there to start your account. I know my BMO one was $5,000, so that's a typical thing. But if you're interested in starting and you're Canadian, there's a link down in the description to get signed up for Questrade. Now that you know how powerful compound interest is, the best way to reach financial freedom is to not only use the power of compound interest, but to save and invest a larger percentage of your income every year. Let's look back at the chart from Mr. Money Mustache's website. I laugh at saying that name, but the name's hilarious, but we're gonna go with it anyways. So there are two ways to do this. To invest more money or a larger percentage of your income, you either need to A, make more money, have a larger income, and you're still living off the same expenses, or B, a simpler way and anyone can do way, is lower your monthly expenses, basically living more frugal so that you have more money left over to invest because it costs less for you to live. For increasing your income, I'd say the two best ways are either one, getting a side hustle where you work on something in your off hours of your work, or two, going up the ladder at work and getting promotions and raises. There are two books I recommend that really, I would think, help with getting raises and fighting for a new higher rate or a new promotion. And they are How to Win Friends by Dale Carnegie and Getting to Yes. I forget who it's by, but I'll show them on the screen now. They're both books about social interactions, especially the Dale Carnegie one, which might sound weird, like why do I need to improve my social interactions when I need to improve my business and to get more money? But realistically, social interactions are almost more important, or are more important than anything else, because if people like you and you're good at talking to people, you can get what you want and people will like you more. Getting better at social interactions and how to talk to a boss, how to talk to a job interview, how to fight for the rate that you want, I find these two books are great for that. For a book on how people live frugally and how those people are now millionaires and how big of a deal it is to lower your income and how easy it is to become a millionaire when just lowering your income, one of my favorite books I've ever read was The Millionaire Next Door. This book is all about the new money, they call it, basically the new millionaires that have made their money and didn't inherit it, and how they're living. And surprisingly, most of them are living well below their means, meaning they're not spending nearly as much money as they're making. They're still cutting out coupons, buying used cars, stuff like that. And I just thought it was really eye-opening to see the power of the tools you have to save money and not get caught up in the material world thinking, I need to have a new car because he is a new car. I need to have a big house because he is a big house. You don't need those things to be happy. And once you find out the things that do make you happy, you can spend more time and focus on those when you're not spending all your money to fill up your life with things you don't need. Last thing before I go, if you want to also get into being more frugal, the number one thing I recommend in a ton of my videos is tracking your monthly income, because you really need to visualize where you can cut back, maybe where your problems are, and see how your spending changes month to month. I use an app called Mint, but the problem with that is I have to log in with all my accounts. So if you're not comfortable with that, you can create your own spreadsheets and fill them out. I personally love doing spreadsheets, and I've made my own Google spreadsheets to track my accounts. Again, you can click down in the description to use mine, but it's behind a paywall. That's just to help me out. You can really make your own spreadsheets. They're super easy to do and they're fun to do on Google Spreadsheets or Excel. The main goal is you need to have all your liabilities listed, maybe have your income and see how much you need to save. But you need to see where you can cut back and make changes in your life to lower that number so that you have more money in your pocket, therefore more money to invest, therefore more money to use the power of compound interest. That little bit of money you save now becomes a lot of money later. So hopefully this video has inspired you to get into the stock market. I can go over more details in specific videos, but overall I wanted to incorporate how cool it is and how fun it is to make a lot of money and use the power of compound interest over long periods of time. Everyone can do this. It's not just a few people. It doesn't matter how much money you have. If you're consistently putting money in your account over long periods of time, taking the market average, you're going to make enough money to retire early. Hopefully this video inspired you. I hope you guys have a great day. Thanks.